Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So this morning we sent out the morning note. We talked about how it's the last day of May, trading day of May. It's a Friday as we head into summer after Memorial Day. It had all the makings of what should be a quiet day in the market. And that's why this market has been a little bit frustrating in 2013 despite the melt up for short-term traders because it likes to throw you curveballs and it never makes life easy. And on a day that we expected to be quiet, we had one of the bigger composure changes in the market of the year from a bearish perspective as we broke down out of that upper level wedge pattern that we've been highlighting, especially late in the afternoon. We really accelerated to the downside, I think, in an unexpected move that not a lot of people saw coming based on the pattern that was building. Maybe we thought there would be a couple more days of range-bound trading, but like I said, we got that acceleration to the downside. It'll be very interesting to see what happens when futures open on Sunday night, whether world markets respond to this late sell-off in U.S. markets, and where we open on Monday morning. But if we go take a look at the chart of the S&P, you can see that move. This is the upper level wedge pattern that we had been drawing right here that we broke down below that trend line. And some people were saying, I read a couple blog posts today that this really could just be a continuation pattern for the S&P. We'd had a big rally in 2013, obviously, well publicized, and we'd formed this wedge pattern. And some people said this is a clear-cut continuation pattern, but in our morning note that we've been sending out, in the morning calls, we've been a little bit more skeptical, and I've been a little bit more skeptical on Twitter as well, if you follow me on there, because what you like to look at is the most recent loud technical signal that you see in the market. That's how you, I think, determine what is really in control of this market right now and where your bias should lie. And in my opinion, if you go back to the chart, you can see that big reversal we had on Wednesday of last week. And I really think that was the most recent, loudest technical signal that we've had. I know we've been strong the whole year, and maybe longer time frames have a little bit more credence than shorter time frames, but I still think that big reversal, there had been nothing that had happened to make that reversal relinquish control of the market. So I still think because we made two more lower highs, I think this had to be viewed as something that would have a bearish bias, and that was the way I was approaching it. The great thing about a wedge pattern is that you don't have to place any big bets in either direction until you get a break higher or lower out of the pattern as that range constricts. And so today, if you were flexible in this range, which we've been talking about, you had an opportunity to potentially get into some shorts on a break out of that wedge pattern, and we also closed below the 21-day moving average pretty definitively. So, and I'm going to zoom into a shorter time frame just so we can take a look at that acceleration to the downside late in the day that I think is really interesting to see. I don't know what the heck's going on with the 5-minute chart here. We'll go to the 60-minute chart, see if that gives us a better picture. Let's go to the East Coast rather than the 24-hour time frame. Still nothing. The charts are a little bit haywire right now, but we'll go back to the daily chart. Like I said, there was an acceleration to the downside in the last 10 to 15 minutes of the session. Selling may go away. We talked about how that adage really hadn't held true to this point this year, but maybe the adage really is sell at the very end of May and then go away for the summer. And that's maybe what we saw today, because obviously we've been very strong for the month so far, but this is leaving a bearish taste in people's mouths at the end of this month. But let's go into some more names, some ETFs and stocks. I'll focus more on the macro themes at the beginning of the video, and then later we'll get into some more individual names. But the TLT was very interesting today. And people have been talking a lot about the potential rotation out of bonds as the Fed looks to maybe taper QE, raise interest rates. I think that narrative has gotten a little bit too out of control. And the Fed has mentioned in minutes and in various testimony about the potential for down the road tapering QE, but I think people have gotten a little bit ahead of themselves in terms of when they expect that to happen. Because inflation expectations are still very low. The economic recovery is still very in its infancy stages. And I don't think the Fed is going to do anything this summer, which is a timeline that people have been talking about a little bit. I don't think they're going to do anything this summer to really change their approach to monetary policy. And today you saw bonds sell off early, but then bounce really strongly in the afternoon that really triggered that downside acceleration. So if we go to the chart of the TLT, You can see that candle that it put on a daily chart. I'm having trouble with my shorter time frames right now after hours for whatever reason on eSignal, but you can see that tail that TLT put in. Early in the day, it was very weak. Traded down below that pivot from Tuesday, I guess that is, Monday, whatever it was. Traded below that pivot. Looked like it might be lookout below for bonds. We could, see the beginning of that great rotation, that whole narrative that everyone's been talking about. But I'm really skeptical about whether that head and shoulders pattern is actually going to play out in the TLT. I think, like I said, I think that narrative about the Fed has been overdone. I don't think they're ready to really change their pace of purchase and their tone yet. I think it might happen sometime in 2014 perhaps, but I think because of the fragile nature of this recovery, I think that story is a little bit overdone, and I'll talk about a couple more charts later that I think there are some opportunities based on the fact that people have gotten a little out of control with that narrative. But very interesting action to note in the TLT, and I think you'll continue to get a bounce in the TLT as we get a snapback from that speculation about the Fed and all that type of stuff. I think you could get a nice contrarian bounce trade in the TLT as it's not ready to see that head and shoulders pattern trigger yet. Gold is another interesting case. I'm not really sure what today's sell-off in gold tells you. I think a lot of assets got sold off today, and I just think it is more reflective, as much as anything, of the fact that people are just souring a little bit on gold. The Fed narrative, if they do in fact start to taper QE and wind down their asset purchases and raise rates, it's a net negative for gold. But you saw bonds bounce late in the day, perhaps as a contrarian play to that narrative, but you saw gold continue to sell off. And I just think in general gold's headed down. I think every bounce that we've seen since the big breakdown below this macro support at 150, I think it's been a dead cat bounce. I think gold is, it's a story that has gotten a little bit tired, and everything in the price action and in policy matters tell me that gold is headed lower. And it's not something that I would look to day trade or even swing trade. I've talked about this in the past. Has a lot of gaps. There's a lot of macro factors that drive it that we don't really understand on a day-to-day basis. It doesn't trade like a stock, so don't treat it like a stock. If you're going to have a perspective on gold, have a short or have a long-term perspective either to the short side or to the long side, but don't try to day trade gold or swing trade gold, because you're going to get caught in big gaps and you're going to end up frustrated. So focus elsewhere if you're a short-term player, and even if you're a long-term player, I think there's much better things to be focused on than gold. I think it's highly speculative and not something that you can really feel comfortable about. Another thing I'm going to talk about is the consumer staple sector. And there's been a lot of stuff written and talked about on TV over the past week or so as that Fed narrative has grown louder about potentially tapering QE, raising interest rates. I know I keep talking about that narrative, but it's really what's driving all of the price action right now. And as rates are rising, in a low interest rate environment, bond yields are very low. People are really on a search for any place they can get yield. And that place has been in 2013, people have been piling into defensive, high dividend yield sectors like consumer staples, utilities, telecom stocks. And you've seen those sectors really sell off sharply as this Fed narrative has grown. And you can see evidence of that on the chart of the XLP more than any of them. It's broken below its 8 and 21-day moving average, below the 50-day. Obviously, relative weakness today, big candlestick down. It took months for XLP to rally here from about the $40 area up to the $42 area, and now all that's wiped out in 4 days. It's an example of something we talked about in one of our morning notes. It was early this week or last week. It was stairs up, elevator down, and that's sort of the market we're in, where you can have a market that rallies and grinds higher for a long period of time, and then just because of the fragile nature of our market structure and because of the instability caused by the Fed, you can get gains wiped out in the span of a few days that it took months to build. So obviously it's a tough environment to be in. I hate it for retail investors that they have to live with that uncertainty and that stairs up, elevator down environment, but it's something you have to be aware of, and it makes risk management especially important in the 2013 market and the modern market in general. We'll go to tech, and it's interesting to note that tech actually showed relative strength today. I was looking at a bunch of symbols that I was going to talk about in the daily recap today, and I started going through tech. I was like, okay, I want to look at some of these tech names to see how they held up, because there was a few of them that I was looking at for potential weakness, but it actually showed relative strength today. The Qs ETF, the NASDAQ ETF, held up above its 21-day while the S&P closed below, and it's still, it sort of started to break lower out of its upper level wedge pattern, but it's still sort of near that trend line, the bottom trend line of the wedge. So it'll be interesting to see if tech starts to show more relative strength. We'll go to a few names in the sector. Google. It was basically the sector was quiet today. You had all these things going on in the broader market. You had the S&P accelerating to the downside, but tech just didn't seem interested in participating in any of that. And Google was quiet. It held up above its recent pivot low. You take a look at Apple. Apple held up in this ascending channel. Ascending channels are, obviously they're bullish because they're ascending, but they're bearish if you get a break below. And I'll be very wary of Apple right here. Scott has talked about a potential inverse head and shoulders pattern. We'll see. I'm not 100% sold on that, but until this ascending channel breaks, you have to expect it to go higher. But if we do get a break, I think it could lead to a trade back down to the 50-day moving average for Apple, and the next level to watch would be the 420 area. But we'll be watching that channel really closely. LinkedIn is one that I have talked about as one that I like as a short setup, but it's another one that just didn't seem interested in selling off the rest of the market today. Maybe they're just trying to confuse people out here by having some of these tech stocks trade inverse to the market or shrug off market weakness one day and then perhaps follow through the next day. But we'll be watching that early next week. LinkedIn, I still like it short despite its relative strength today. I just think it was trading a little bit separate from the market and not a huge thing to take note of. It's still below all of its moving averages, 50, 21, and 8-day. Those are curling down, so this is one I expect to go lower. But it was quiet today. Netflix was actually very strong today. This is one that, this big engulfing down bar was one that I think was a sign to take caution, but it's actually been able to bounce back really well from that. And with today's gap up, it held most of that gap or all of that gap and actually accelerated higher for much of the day. It's back above its 8 and 21-day moving averages, so it doesn't look like the music has stopped yet for Netflix. And today did a long way towards repairing that chart. In Intel, interesting case. Scott talked about it this morning. News came out that they were awarded they're basically going to be producing the chips for all the new Android tablets, all of Samsung's new Android tablets. And that was positive news for Intel. I think maybe the broader markets might have weighed on Intel a little bit more. It's more of a bellwether stock in the Dow. And it tried to break out today but failed. And I think this is one where it showed that it could hold up in a weak market, and it tried to break out before macro market weakness weighed on it. And I think if the market is able to bounce next week, or whenever the market is able to bounce, I think you'll see Intel break out of above this pivot and get back, to the 25 area, be your first target. And then I would definitely not be surprised to see Intel get back up in the $27 area. Yeah, but that's about it. I think more of the story today was the macro market weakness rather than talking about individual names. You had Tesla weaken a little bit. You had Solar City, the other Musk stock, weaken a little bit. But I think today was more about the macro. Looking at that action in the TLT, I think it'll be very interesting to watch bonds and see how they affect the broader market and whether they can bounce or that head and shoulders pattern does start to play out. Like I said, I think we'll get a bounce in bonds from these levels. I don't think that head and shoulders pattern is ready yet. And I think that Fed narrative about QE coming to an end and raising rates, I think that's all gotten a little bit overdone. And I think you can play a little bit of a contrarian trade in that space. But that's about it. It'll be a very interesting week next week as we, like I said, respond to what world markets do on Sunday night and when futures open. But this has been John Darsie here for your daily recap, and we'll see you early next week.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.